Alright, moving along with part 3 now of the chapter 4 presentation. We're on slide 46, and just to again add to their more sophisticated way of presenting the T accounts for accrued expenses, I've made it a bit more specific here on the whiteboard by indicating a specific expense account called salaries expense with a debit of $500, which is the amount of the adjustment that was needed at month end, just as a hypothetical example, with the related credit going to a liability account called salaries payable. So the slide is just showing you a general example of an accrued expense, the debit to an expense account, the credit to a liability. I'm just adding a little more specificity by using the example of salaries. The point is, we're increasing or debiting an expense account, and we're increasing or crediting a liability account in doing this month-end adjusting entry for an accrued expense. On slide 47, in this example, there's a 3-month note payable with 12% annual interest. This means that the annual interest amount would be $600 if the note was held for an entire year. The monthly interest, therefore, would be $50, or 600 divided by 12. Although the actual interest won't be paid until the note comes due, the accrual needs to be recognized at the end of October, since 1 month of the note has elapsed, and therefore 1 month's worth of interest expense has accrued. That also means that a liability for the obligation to pay this expense later must be recognized, that is, the interest payable account being credited for this amount, as you can see in the journal entry and the postings to the general ledger made on the slide. Slide 48, this is just another one of these vignettes showing by switching to accrual accounting for this one instance and for expediency's sake, the Chinese government was not being consistent in its application of accounting. You can see page 223 of the text again for a further discussion of this. Excuse me. Moving to slide 49, adjusting entries for accrued expenses again, and you can see from this example that based on the pay periods and pay days, the company has a 3-day period at month end for which salaries have been earned but not yet paid. Therefore, this accrued amount must be recorded as an expense of the period, although it has not been paid and won't be paid until the next period or month. On slide 50, here's the accrual entry and related postings for the last 3 days of unpaid salaries accrual. Note that the accrual was calculated based on determining the average salary cost per day of $400, and that was based on total salaries per week of $2,000 for 5 working days per week. So 3 times 400 gave you the $1,200 in salaries expense and payable that needed to be recorded. On slide 51, again, here's the presentation of the reasoning behind the accrued expenses entries and the impact of failing to make them. That is, expenses and liabilities would both be understated. And again, this failure does not in itself cause the accounting equation to not balance, but it's still an error condition because it's an omission that is basically in violation of GAAP. Okay, on slide 52, here's a summary of the 2 main types of deferral entries and the 2 types of accrual entries that define adjusting entries and what types of accounts are affected. You should know, that is, memorize the type of adjusting entry for which one as shown above, that is I'd probably say for each one as shown above, that is for prepaid expenses, there will be a debit to an expense account and an associated credit to an asset account, and so on. Okay, on slide 53, the adjusted trial balance needs to be prepared to ensure the company that after all the adjusting entries and postings have been made, the total debits and credits remain in balance. That is, they match. As stated on the slide and in the text, the adjusted trial balance is the primary basis for preparing the final financial statements, so its accuracy is paramount. On slide 54, as you can see on this slide, and also shown on page 183 of the text, the figures in red are the accounts that were involved in the adjusting entries, quite a few of them. If you compare this one to the preliminary trial balance shown on page 168, you'll see the differences, including at the bottom line. Both debits and credits are greater than they were originally. Alright, so on slide 55 we have a review question. Hopefully after what we've been discussing you can see why answers A, B, and D are all correct, leaving C as the only incorrect response regarding the adjusted trial balance. The adjusted trial balance, as does the preliminary trial balance, lists all accounts, not just assets and liabilities, as answer C implies. On slide 56, as shown here, the financial statements can be prepared right from the adjusted trial balance results, starting with the income statement, going to the retained earnings statement, and the balance sheet. And again, from previous chapters, I hope you recognize by now why the order has to be maintained, because net income is needed for the retained earnings statement to get the ending balance of retained earnings, and the ending balance of retained earnings is needed in the balance sheet. On slide 57, note how this visual aid shown on page 184 displays the transfer of the adjusted trial balance amounts for the revenue and expense accounts into the income statement. Then the beginning balance of retained earnings, dividends, and net income are transferred to the retained earnings statement as shown. So that's a good visual of tracking where these balances go. And on slide 58, finally, the assets, liabilities, and stockholders' equity accounts, including the ending balance of retained earnings, are transferred to the balance sheet. Note again the format of presentation, with the current assets first, then the equipment less the accumulated depreciation. Then the liabilities, all current in this case, followed by the stockholders' equity that includes both common stock and retained earnings. I know some of you are still kind of struggling with the format and the order of presentation, particularly in the balance sheet. So please pay close attention to that. Alright, we're moving now to closing the books on slide 59. And by closing the books, we mean that revenue and expense accounts are set back to zero so that there is no carryover to the next period. That is because we want to measure performance accurately for each period, and only for the revenue and expense transactions that occur for that period. Again, we're trying to match them to each other for that period. So therefore, the revenues, expenses, and dividends as subdivisions of retained earnings are temporary accounts because they are closed out at the end of each period. On the other hand, balance sheet accounts, assets, liabilities, and stockholders' equity accounts are permanent in that their balances carry over from period to period. So the purpose of closing entries is to transfer the net income or loss and dividends into the retained earnings account, which is what is happening with the retained earnings statement. Note that the adjusted trial balance still shows the beginning balance of retained earnings, and this must be updated at period end. On slide 60, by closing the revenue and expense accounts with closing entries to the income summary account, the revenue and expense accounts are set back to zero balance in preparation for the next accounting period. The income summary account is also a temporary account, and its balance after all the closing entries is transferred to retained earnings to produce the ending balance of retained earnings that should tie or match what's in the retained earnings statement and the balance sheet. So on slide 61, let's walk through these closing entries, which are also shown on page 188 of the text. First, the service revenue account is closed by debiting service revenue, a credit balance account, for its total balance for the month, and crediting the income summary account. Next, every expense account is closed via a single journal entry that debits the total expenses amount to the income summary account. In that way, the expense accounts are zeroed out. Then the income summary balance is closed out via the third entry above. Note that since revenues exceeded expenses, there was a credit balance in the income summary before it was closed that represents the net income earned for the period. This means that income summary was debited to reduce its balance to zero, and the associated credit was to the retained earnings account, thereby increasing retained earnings by the amount of the net income, remembering that retained earnings is a credit balance account. Finally, the dividends account is closed by crediting it for its balance amount and debiting, that is, reducing retained earnings for the same amount. Moving to slide 62, here's a T account presentation of the closing entries as shown on page 189 of the text. Note that the flow of the balances out from and into the income summary and the retained earnings accounts. And remember, all this is going on after the financial statements were prepared, just to set the books back to what they need to be for the accounting for the next period. So on slide 63, as a final step in the process, a post-closing trial balance is prepared to ensure that for the remaining accounts with non-zero balances, that is the permanent accounts, the total debits still equal the total credits going into the next accounting period. At this point, all temporary accounts, revenues, expenses, and dividends will have zero balances. And on slide 64, so here we have the whole accounting cycle is also shown on page 190 of the text. This is a good wrap-up of what we've covered and a good thing to commit to memory so that you will know the flow of the process but also understand why it needs to take place in this manner. Note that even after the financial statements are prepared, there are two more activities: journalizing and posting the closing entries, and then preparing the post-closing trial balance. The key is understanding how to journalize a typical accounting transaction in terms of which accounts get debited and credited, how to properly post the journal transactions into the general ledger accounts, and from there prepare an initial trial balance. After that comes the adjusting entries of various deferrals and accruals, the adjusted trial balance, and the financial statements. Note that how one activity naturally flows into the next, that is, each one is necessary before the next one can begin. Slide 65, the point of this slide is that companies often try to make their financial results look better than what they are. However, one-time items should be disclosed in the notes to the financial statements to promote transparency in reporting. The other two items, inflating revenue numbers or improper adjusting entries, are just flat-out no-nos. As the slide and text indicate, the Sarbanes-Oxley Act has been a deterrent to these types of activities because it's increased the penalties for doing them. On slide 66, as this slide discusses, there is usually a difference between net income reported on the income statement and net cash provided by operating activities as shown on the statement of cash flows. The breakdown on page 192 of the text, as shown on the next slide, displays these differences. And on slide 67, as you can see, there are several items involved in computing the net cash provided by operating activities that were not included in the computation of net income and vice versa. For instance, the cash received in advance from the customer is only recognized in net income to the extent it was earned. That is entry 4. Services provided on account recognized in net income are not recognized in the net cash provided by operating activities since no cash was received yet. Neither are any of the expense items reflected in the net income column shown on the net cash provided column because no outlay of cash was made specifically for these expenses. It may have been made earlier for the associated assets such as supplies or prepaid insurance. On slide 68, this slide starts a discussion that begins as Appendix 4A on page 195 of the text. So we're looking at automating the process somewhat here. On that, I'm going to conclude this portion, and we'll just have a quick part 4 to wrap it up.